So I'm happy on behalf of Reed Smith and Michael and his team to welcome all of you. My colleague is sitting in the corner, so I have to say a little bit about Reed Smith.
Please.
And one of the things that doesn't, for reasons that I've never understood about Reed Smith, I mean, I've had a wonderful time here, really. It's been a great experience here. They don't really talk about their role in venture capital and building companies. The firm was founded in Pittsburgh in 1870. They represented the people who built America. Frick, Mellon, Westinghouse. Carnegie Mellon was incorporated by Reed Smith. You know, we were there at the beginning, and yet when we talk about what we do in local venture capital, entrepreneur pool ecosystem, we don't really talk about this legacy that we have. You know, it's unfortunate, but I'm telling all of you about it because, you know, it's part of our bloodstream here, our DNA, that we've been helping entrepreneurs get capital and grow and taking care of all of their business on a global basis. We have 29 offices around the globe. Our largest office is in London. Offices Hong Kong, Shanghai, Beijing, Singapore, Tashkent, whatever it's called these days, Paris, usual places, and a bunch of offices in the United States, Austin, Texas, Dallas, Houston, New York, Princeton, etc. And what I do and what the team that I work with does is we represent the entrepreneurs and the people with the capital marrying each other and growing interesting companies. Part of what that involves for this purpose is, you know, so how is it that people who are involved in these companies can exit? We all know about the, you know, fantastic opportunities to exit companies by going public or M&A. I actually, you know, noted down some statistics for this purpose, and as you might guess, and as Henry mentioned, I've been around in Silicon Valley for a long time. The lack of hair will tell you some part of that story. The other part of the story, as Henry mentioned, was that I was actually at a little company named Intel, which had 250 employees at the time, on January 11th, 1971, which is the birthday of Silicon Valley. It's the first time the word appeared in print talking about the semiconductor companies. And so I've been going down 280 ever since. I live in San Francisco, however, and it's taking a lot longer, and it's a lot less fun. So anyway, I was thinking about, are we in a situation like we were in 1990 and 2000? You know, I used to do talks on the history of Silicon Valley and talk about this fantastic surge that happened at the end of 1999, the first quarter of 2000, when $29 billion was invested by the venture community in 2 successive quarters. And in 2000, $117 billion invested, you know, that year. So how does that compare with today? Well, that record got eclipsed in the 4th quarter of last year, and when $36 billion was invested in venture. And last year, we got close to the all-time record. Probably not going to make it this year, but $115 billion invested in young companies. Exits. You know, there are 180 unicorns now in the United States. Companies worth more than $100 billion. You know, they have raised more than $100 billion. The total value of those unicorns is $620 billion. There were 185 mega deals last year of $100 billion investment. Series E, F, G, okay, and then we have WeWork. So what does that mean for the participants in this infusion of capital? Are they locked up for 10 years plus 1 and 1? And what about the employees? What about the people who built these companies? Not just the capital, It's other participants who have an interest in liquidity. In the old days, back in the day, in the 90s, you waited until there was an exit. And back in 1999, the public was the exit. The public had this appetite for young companies. Anybody remember Pets.com? Lots of very interesting companies that attracted public capital, and the employees of these companies, you know, company went public, got traded in the exchange, the lockup was over, and they got out. Well, it's now the case that these large aggregations of capital have money to deploy, and companies are living longer and longer and taking more and more money in, EFG, et cetera. And where does that leave the employees and people who are interested in getting exits, and how can they provide exits? Part of what's happened is that the pressure from the senior employees of the company who've been working there and have options that are in the money, well in the money, who are vested after their 4 years, you know, it may be time to move on. How do they get out? One of the things that happened with Facebook was that Zuckerberg, when he took in the capital, convinced the investors, you have to set up a pool to buy some of the common from the employees. And so when Yuri Milner came in with $100 billion into Facebook, part of that money went into buying shares from the employees to control the number of shareholders because of the 500 shareholder limit on disclosure, et cetera. So we had this dynamic where the employees are interested in getting out, and then we have people who are setting up funds, this is where we're talking about secondaries here, who want to get in. And they want to get in on the latest hot deal. They'd like to buy in on Facebook or Uber or Lyft or whatever at a discount to the last round price, typically 30%. And so a market is developing, not a particularly liquid market in the sense of the stock exchange, but a market's being developed, and our panelists are going to talk about all of this stuff. So that's why we're here. We're here to talk about the dynamics of the tech economy, the capital that's in the tech economy, the locked up value that's in these companies, how do people get liquidity, how do people who want to invest in these companies get in if they're not part of a venture fund, et cetera. And so we've assembled a panel of people to talk about these things. You've all read their resumes, so I'm not going to introduce them. If you've forgotten about them, they're in your hand. So tell us a little bit about yourself and what your company does, and then we'll get going on the Q&A.
Sure. Hi, my name is Michael Caruso. Mostly a serial entrepreneur. I lived through what you were speaking in the 90s. Sell the internet database to Amazon, IMDb, as an operator. Felt the pain of 2000 as an investor. And now I've done a number of secondary market transactions as a form of a buyer, fund manager. Helped a friend of mine, an early employee at Facebook, do a transaction, did some transactions as well at Twitter in the early days, and fast forward now, putting together a number of funds, some to invest in secondary investments.
Sorry, Glenn Anderson. I'm the president of Rainmaker Securities. Rainmaker Securities is a merchant banking company and been a registered broker-dealer. We have offices in Los Angeles, Silicon Valley, New York, Chicago, Miami, and Hong Kong. And we focus on private placements with a large practice area in trading late-stage pre-IPO secondary shares. We advise on 300 transactions so far in 2019, representing a value of about $1.5 billion. I come from a tech background. I graduated as an engineer, worked for Motorola in the 90s, and then worked for some dot-coms that didn't last in the late 90s, so I'm very familiar with that period. And then after going to business school, I switched to finance,
Ventures. We are a platform of venture capital funds, one of which is focused on venture secondaries. We buy stock in later stage private businesses and LP interests in venture funds that are concentrated in late stage companies. We manage a little over $3.5 billion in capital across all the funds. We're LPs in 350 different venture funds, direct investors in 250 companies directly. I oversee our origination and sourcing efforts, so finding new managers for the fund of funds, companies to invest in, and secondaries to buy. I also oversee our data collection and analysis efforts across portfolios in the broader market. Excited to be here.
All right, so I'm going to start with a provocative question. What's the effect on the secondary market of the collapse of WeWork, of Lyft, and Uber? All these companies that the public would have thought continually up and to the right. The poster child for this, of course, is WeWork, which is worth less than SoftBank's put in recently. Not even the cash they put in. They lost money in putting that cash in. How do we know this? Because there's a comparison company that's traded on the exchange that's worth less than SoftBank has put into the remnants of WeWork. So, how does all that activity impact the market that you guys play in, which is secondaries? Are people going to shy away? Clearly, from the standpoint of the early employees at these companies who wanted to get out along the way, if there was an exit path, they would have said, we got out of WeWork at a 30% discount when it was worth $47 billion. Okay, we did okay. But, we now know that a lot of these companies are filled with some hot air. So what are the dynamics? Is this going to impact the business, put a damper on trading in secondaries, or is it just the way the market works? So, come on, guys.
Take that. All right. Well, I will say we haven't seen any slowdown in business whatsoever this year. In fact, we're having a record year. Still a lot of buyer interest in lots of different unicorn names, and still a lot of sellers looking for liquidity. I would say Uber and Lyft and WeWork are corner cases, although obviously significant corner cases. But WeWork, was a real estate firm masquerading as a tech company, and it only took the public markets with a critical eye to see that. And it's amazing what the situation SoftBank got itself into with WeWork, but that's another conversation. With Uber and Lyft, it just came down to the ride-sharing business and the fundamentals. It's slowing. The market for ride-sharing is starting to slow, and these companies are in a bitter battle with each other and losing money, and they're losing a lot of money. But in terms of other names that we, in other parts of the unicorn ecosystem, we're still seeing a lot of investor interest in a lot of different names.
Yeah, I would agree with that. I think that the correction that we've seen in some of these names, like Uber, Lyft, and WeWork, if anything, has just signaled to the market that some of the high water marks that get set in the private markets may be a little bit too high. I think it'll create a lot of buying opportunity for funds who are focused on secondaries. To your point, I think the employees who sold WeWork on the way up are probably feeling pretty smart right now. I think there will be others. There are a lot of companies that have raised at overzealous valuations, and a lot of buyers who have probably overpaid for businesses that are capital intensive, maybe don't necessarily warrant decacorn valuations. But to your point, Glenn, I think the market is still quite healthy, and there are a lot of great businesses
it depends on when you get in. I mean, because I was involved in a fund that got in and lifted $6 billion. If you get in early enough, as an investor, why is as long as it's not completely overinflated and delisted, if it was public, that's cool.
Yeah, it's a matter of knowing whether it is overinflated.
Right, and everything's overinflated. The world's over. We just heard about all the cash and capital chasing deal flow, right?
Right.
So that's a natural macroeconomic issue.
My name is Edward Strickland. I'm a Stanford angel and entrepreneur. So on the buy side, do they see these opportunities for down rounds to invest in these companies now? And on the founder stock and founders positioning, would it be wise for them to position themselves on the board as participating preferreds for their positions on the exit so that they're the first out? New strategies for coming up CEOs.
So I think a couple things there. I haven't seen a company where a founder has been able to structure their own shares as senior to the other investors. I think it would create some misalignment. We have seen founders buy senior preferred from other investors, but I think they might have a tough time getting board approval to make themselves the first money out. Could certainly happen in a different market environment.
Well, the reason why I say that, because it's an evolution of the ecosystem. Because if you bring something up with value and you think that you're going to be taken out, you have to position yourself well in advance. So that's a consideration that they're talking about.
Definitely. If I were a founder and I were starting a company and that was something that I could do, I would probably do it. I think the market dictates the terms for these financings today, and I don't know that the market would accept a founder who's senior to the other investors, but that could very well change. And to your other question, we have seen a few down rounds. I think there's certainly the minority of financings, but would expect that if and when a correction comes, there will be plenty of others.
Well, you can always get leverage by getting 20 votes for every one.
So
yeah, to add to the point you're making about the down rounds, after the Facebook debacle, when its IPO didn't go well, the market for secondaries basically just froze up. At least that's what we saw in our business. There were a lot less interest in secondaries, fewer trades going on. Now what we're seeing is prices, supply and demand goes into play, and prices simply adjust. So we are seeing lower prices. We are seeing still, as you said, a healthy market for secondaries, but pricing is adjusting to reflect the new reality of the markets.
What do you think about the impact of the direct listings, the Spotify's, et cetera, where there's no underwriter to cause the pop, and its impact on pricing and the liquidity of shares?
Well, Spotify was a successful IPO, and Slack was initially at least a successful IPO. So I think it goes to show that direct listings don't necessarily create a situation where you can't have a successful price action at the open.
Your comment about Facebook was indication that without the pop, the market dried up.
Yeah, with the aftermarket performance of Facebook it was over a period. So after the first 6 months of Facebook's public life, it was down into the right. It was it created a sense that tech valuations it affected the secondary market. We saw it where it just dried up a lot of buyer interest in secondary names. But now, my point was, now what we're seeing is just supply and demand go into play, and we're seeing pricing adjust. So we're seeing a healthy market environment.
So are you suggesting that because of the depth of the market now, that there's no one company that has a collapse like WeWork that's going to cause the market to make a dramatic change, like
Exactly.
Facebook example?
Exactly.
Facebook was the first company that really did, well, not the first, but one of the first to do secondary, right?
Yeah.
And it was a debacle because as a buyer myself, it was ridiculous. You get on a phone call, Maybe 6 people on the call that knew someone at Facebook. Everybody had their hand out. It was a nightmare, right? You all lived through it?
Yeah, it was, you know, the hairdresser of the secretary of the engineer and that owned the shares that you'd be on the phone with for sometimes.
Joke. And you know, the fact is, it was at what, $38 a share, if I recall, or something like that. And what happens in the public markets? Things go up, the institutions drive it down, and it goes back up again. So it's just, it's reactionary malarkey, in my opinion.
Mike, what about the historically low interest rates, giving sort of a floor to a lot of things and creating more risk capital anyway?
Exactly. That goes
So
all
isn't that
yeah.
one of the big things?
It's fueling everything. I mean, what Dan was talking about earlier, how much money is out there chasing deals?
How much money is out there
Well, did we just
chasing
hear-
secondaries?
Did we just hear it's a percentage of the trillions? Family office have 25 trillion, private
Yeah,
office 3
but they're
trillion.
not playing in your world.
Oh, no, it's still small, it's still new. I mean, don't you think it's still new?
But, you know, there's other examples, like
Yeah.
DocuSign was actually pretty undervalued relative to effort in the public.
Yeah.
Did very well on the public markets, and
Yeah.
Stripe's another example, or
Yeah.
Zoom's another example.
Stripe's another company that, you know.
Beyond Me, obviously.
Yeah.
I mean, you just have to be smart. I mean, unfortunately, you have to do something.
I got a question on strategy at this point. So let's say you are undervalued at this particular position and you wanted to leverage up. Would it be better in the interest to go to the business development area, the private equity, or to go to the family office to be able to maintain the positions in these well-known brands? Because eventually they will succeed. WeWork's innovation and its social innovation is something that's deeply needed and it's just not promoted correctly. I mean, they came in as a technology play for the extra funding, but they weren't, but they had the considerations of which technologies they wanted to implement to make work easier, life easier, and eventually we have to evolve and move to that position, so they're in a well-positioned play with brand. Someone will pick them up and take them across the line. Who would that be?
Well, there's still 20% of WeWork that's not owned by SoftBank. And presumably those people that own the 20% might be interested in some exit.
See, SoftBank's one of those positions that they have their hands tied because they have shareholders to answer to. But if you get to an independent play, they can position it to a stronger position. It's a matter of what their interest is in long term.
Yeah, WeWork's a good example of what we were talking about earlier, where supply and demand are coming into balance, because believe it or not, we still have, I mean, I have a couple buyers on the books still looking at investing in WeWork, albeit at a much, much, much lower valuation than where it was just months ago. So, market, like I said, the market's adjusting well.
You guys, we have a moderator.
No, that's all right. No, it's fine, it's fine. This is, my role is to make sure there's a dynamic between the people who are here and want their questions answered, and, when they don't ask any questions, then I have to ask them, right? So, I'm gonna go back to the question I was trying to get at, which is, do you have some collective sense about how much capital is out there looking for opportunities to buy secondaries in tech companies? Are we talking $1 trillion, 200 million? What's your sense of the size of the capital it's looking to buy, leaving aside the people who are looking to sell? Anybody got a finger in the air?
Given
Make
China
a
and
Las
Middle East,
Vegas
it's probably
guess?
no.
Yeah, I mean, I think it's very dynamic. There are buyers like us who do one thing, and we have a pool of capital that we have to put into one type of asset, which is venture secondaries. Then there are a lot of other non-traditional buyers out there who can kind of flex in and out of venture secondaries as they see fit. In recent years, kind of to Jim's question about interest rates, there has been a lot of risky capital seeking to buy growth. And a lot of these successful IPOs have been the fastest growing companies in history, so naturally a lot of that capital has flocked to venture secondaries. Whether or not it's found the right home is probably a different question. So I think over the last few years, there probably has been more capital looking to buy than there has been supply available. But I think it kind of bounces around quarter to quarter.
I are you guys seeing any situations where, you know, a large LP, like Stanford once tried to get rid of its portfolio, they couldn't get the right price, so I think it didn't happen. Is that under the radar here? It's going on, or?
Well, that's obvious. I mean, you know, NASDAQ has the GP-led side. You guys buy a lot. The industry buys quite a bit from venture. I mean, whether you access it through direct or through an LP interest, again, you're just buying securities.
So it's not just the employees who are
Oh, absolutely
playing
not.
this game. It's the LPs are also
Yeah.
getting out before the big liquidity event, the M&A or the.
Maybe if I have a 7-year or 5-year fund. I mean, the fund we're setting up, probably have 5 years on it. If I want to liquidate some of it, thank God, I can go to somebody,
Okay.
a market, an exchange. Morgan Stanley has one now, NASDAQ, or a direct buyer. There's a whole bunch of secondary funds. And sell it at whatever price you can get. Right?
Hey guys, thanks for being here. I'm a fund entrepreneur. My name is Michael. I run B Partners. We're a pre-seed fund, and so I've done a transaction with one of the three of you on the panel, so thanks. My question, I have two questions. First, what's the minimum enterprise value for a company to really start having some interest from the secondary buyers? And then the second question is, what can I do and what can fund managers do to prepare their teams for that time when secondary buyers are going to start having some interest in their companies? We don't want to distract our founders because they're running and building businesses and great companies. But on the other hand, we know that it's a reality that they should plan and anticipate for. Thank you.
Well, I can tell you what we see, which is the overwhelming amount of interest is still in unicorn companies. It's just, they have, part of the problem is with a secondary transaction, often you don't have diligence, right? When you invest in a primary round at a company, they give you all sorts of diligence. With secondary trades, companies are, you know, usually don't provide you any sort of dilly file, and sometimes companies are outright hostile to secondary trade, so that creates a problem too. Sometimes they're trying to transact, but because of the fact that you can't get diligence, the bigger names that are more well known, that have a lot more news flow, that have a lot more information, articles written about them, they tend to get more interest because you can diligence them easier. But we are seeing an expansion. I mean, at least in our business, we are starting to see some get approached by some investors for sub-unicorn names, more under the radar stuff. It's grown as a part of our business, although it's still small. It's grown as a part of our business over the past couple of years, and I expect that trend will probably continue. But I can't give you a definitive number, like 500 million, or all I know is the unicorn names get the most attention, and then there's some interest coming in from some unicorns.
Yeah. I think it depends on the brand. Like, I mean, I've seen some $500 million deals, but I think on that, with the earlier deals like that, you have the investor needs information. So the company has to be willing to do the tender offer, or a liquidity program, whatever you want to call it, where there's access to information for a company that is not the unicorn. At least that's what I've experienced, having run some company-led liquidity events where we're working directly with the company, with the founders, with the document room, providing everything that you receive in a primary, but it's a secondary. And there's liquidation preferences, all those things, they get answered.
If there are 180 unicorns at the moment,
It's 300.
just in the United States. I don't know.
I don't know.
News
My
I
numbers
read
are
this morning
different.
was 180, so
I read 300
whatever.
It doesn't
Anyway,
underdog.
it's a number, X, we'll call it X. It's a significant X.
Yeah.
Of that X, what percentage of those companies actually have liquidity programs in place to deal with their employees?
Many of them are very quiet about it.
Well, okay, but you guys have your ear to the floor.
I would say almost none. I mean, occasionally we'll see a liquidity program for employees, but it's not, I mean, in my experience, it's not common.
I think not a few, but you probably see more than I do.
Yeah, we don't see a significant number of company-led liquidity programs, but we do see a lot of our secondary components of a primary financing. So if there's a $50, $100 million round, the company can carve out $20 to $40 million of the capital to buy employee shares and keep their employees happy.
But wouldn't most of those transactions be cram downs for just the basic IP? Because what would be the value if they didn't have the exit strategy in the beginning of the acquisition? Because if you didn't have your acquisition partner in the beginning when you developed, you were out in the open market, then you show weakness because a buyer doesn't necessarily have there's not multiple bidders for the seller.
It is what
That's
it
what
is.
has to happen. If you don't have the multiple bidders on the buy side, how do you leverage up on the sell side? You don't. You wait. And so
We don't talk
one
about it
interested
anymore.
buyer would definitely cram down and wait for weakness.
Yes, the gold makes the rules.
It's an efficient market, so if it's a good company and investors have access to some level of information, chances are there will be buyers at a certain price. There's enough capital out there that you can typically find a buyer for your shares. If it's a company with very low volume on the secondary side, you just have to do a little bit more digging and work with folks like Michael who know who the buyers are to help you out in there.
I have personal experience with this with IWG. They're WeWork's competitor. Back in 2000, we owned 9 franchises of HQ Global Workplaces. Consolidation in the market came that they needed our assets in order to build up their portfolio to go to the investors. So what happened was they were the only bidder. And so what we accepted, 10% of what we thought that we would get because we didn't have that. So that's my experience with the merger acquisition on that.
So, in the real world, you think that it's ever going to be likely that management, other than in connection with a financing round, leaning on Yuri Milner to buy up some of the management stock, in connection with a Series C financing or whatever, is there ever going to be a situation where management is, for whatever reasons, going to be really encouraged on a broader basis than sort of random to provide exit opportunities for the worker bees? That is not going to happen, right?
No, I mean, it comes down to company philosophy. I mean, certain companies are very hostile to the secondary market for a lot of reasons, and certain companies are very open and want their employees to benefit from their paper wealth. I mean, Spotify was an example where we did a lot of trading in Spotify in the past 5 years before it went public because it was very supportive of the secondary market for the shares. It wanted its employees to benefit from their wealth. Uber was diametrically the opposite, as is Airbnb. There was no liquidity allowed, no selling allowed, and the only way to transact in those names was through special purpose vehicles or forward contracts. So,
And how much of that goes on?
We don't do a lot of forward contracts, but there are brokers that do. So there's a lot of, we know a couple brokers that have done a lot of forward contracts in Airbnb.
I mean, Airbnb, you have to buy the SPV. Like right now, working on something that, you have to buy, like you said, you have to buy in through an SPV. So, I mean, for me, I've seen a few liquidity programs that were sponsored by the company, but they were very, very, very quiet. Wasn't, they're not running them across some platform.
You guys
Okay,
bought
well,
that NASDAQ private market, Richard, you know, we've got over guest speakers in the past. We had Andrea Lamari, who was from NASDAQ private market, and you know, NASDAQ private market's very interested in doing these very orderly liquidity programs where they have buyers that'll come in and purchase stock and stuff. It's almost, you know, very systematic and stuff. Do you think they're going to be successful encouraging the 90% plus that don't have formal liquidity programs, or not?
So some of the companies I know don't want to touch that with a 10-foot pole because they're going to keep it quiet. You know, you know, Monahan, Tim Monahan over there now, I know him pretty well. I mean, it's just a very difficult situation where you publicize to investors that you're allowing. I mean, many years ago when we were in the 90s, when I was working for, you know, startup companies, couldn't sell your shares, right?
Right.
Like you mentioned.
Right.
Well, that attitude hasn't really changed that much, right?
Is the pool of buyers, are they all people who live within 50 miles of where we're standing? Or is international capital interested in this?
No, there's a lot of, most of our buyers are outside of Silicon Valley. In fact, that's one of the reasons why we have a business, I think, as a broker, because if all the funds were located in Silicon Valley, you'd throw a rock around here to hit an entrepreneur. So it's easy to find the deals. It's easy to be plugged into deal flow if you're based in Silicon Valley. But if you're not based in Silicon Valley, if you're a European family office or a Middle Eastern institution or a Hong Kong-based VC fund that wants to get into U.S. deals, that conversation a lot of times starts with a broker who gives you access.
What about your fund? You raise capital to buy into these kinds of things, right?
We do, and we see the full spectrum of traditional investors participating in the same types of deals. Sovereign wealth funds globally, family offices, even hedge funds who look at venture secondaries as an alternative way to buy in prior to an IPO and get some extra juice.
Clay, did you have a question?
Yeah, I was just curious to hear, what have you seen, this is to everyone, but particularly Glenn, what have you seen as some of the most effective diligence strategies that your clients have used on private companies?
Good question. This is probably a better question for you, Camper.
Spray and pray.
We see a lot of buyers buying blind without information and using market rumors as a substitute for diligence. As an RIA, we need some level of information, and we can get that through different channels, whether it's from the company directly or other people we know who are invested. I do secondaries in general, secondary investors in general, typically don't have as robust of diligence requirements as primary investors.
Yeah, I mean, there's publicly available sources of data, like Crunchbase or PitchBook. I have some good information there about some of these companies in terms of the rounds that have been done, and sometimes there's revenue numbers and sometimes there's not. But you know, a lot of it, as you said, a lot of it is just blind. You do your diligence on what's available in the public domain, whether it's news flow or rumor or what it might be, and then make your thesis based on that. So.
Yeah, and it's usually just based on the last round or some discount thereof. So
Yeah, that's a good point.
It's pretty much just, okay, last round at this valuation, you know that there's some liquidation preference whether you happen to invest in a VC fund or another fund. It's very loose.
Yeah, yeah, that's a good point. So a lot of times, how you set your price is a bit on the basis of the last round. So you know the smart money went in at let's say a $2 billion valuation. So you buying common shares, that was a preferred round at $2 billion. So you'll slap a 10% discount on that number and come to $1.8 billion valuation. And that's where you'll buy the common shares. So it's sort of a rule of thumb we see in the business.
I think research helps too. Rainmaker, Internet Securities, we both write a lot of equity research. And that, you know, it's not perfect, but it's a step in the right direction, you know, instead of just going in blind. What sort of discounts are you seeing in the secondary
transactions from the last round. 10% seems pretty light,
It's
considering the risk.
It's about right, about what we see.
I'd say
So
that.
it's say common is usually trades at a 10% discount to the last pref round, depending on the time since the pref round, but the pref round was 3 years ago. And in some cases it might be that it's harder to use that as a rule of thumb, but if the pref round was 3 months ago, then a good rule of thumb that we see is 10% discount for common.
It depends on your role. I mean, if you're just trying to get the deal done in a transaction and you're in the middle, it's just get it done, right? And, if you can get it discounted, great, but.
Would it be strategically to show yourself as undervalued when you go to, because of tax reasons, or your revenue can come, and then when you go into negotiation, you reveal what the true asset is at that time?
Talking about 409A?
Yeah, for
There's always that argument.
I mean, because most 409As, you don't want to show that you're worth that much. But then in reality, if you look at the true asset, you're really worth much more, 10 times. Then when you go into negotiations for the exit, you demonstrate that you're worth that value, and then that's when the due diligence come in at that particular point when the transactions occur. Wouldn't that be a better strategy altogether?
I think the 409A often gets set by an independent third party, and I think they use very different techniques.
Yeah,
of
it's
valuing
usually like Reed
the
Smith, they do the 409As, they do it here, they do it in the client's interests.
We don't do the 409As.
No, that's
Okay,
the
so there's
valuation.
those
It
variations.
does that specialized financial accounting
Yeah,
stuff.
that's a valuation firm.
Can I ask a question about bundling shares? So, obviously, you're trying to do a larger transaction, you try to get some type of allocation of shares on behalf of your buyers. Who's bundling that? Who's creating that larger scale of shares to transact for a secondary transaction? Is it coming from a cabal of employees that get together and decide that they're gonna sell? Is it coming from earlier investors that have relationships with the organization and can affect that transaction from inside? Can you kind of illuminate that a little bit? I think it'd be helpful for me at least. I'm not sure about the rest of the audience. Does that make sense?
Yeah, if we're going after an asset that we like, the onus is typically on us as the buyer to pull together enough shares to make the transaction worthwhile. And we'll often see brokers do that work for us and kind of shop that bundled collection of sellers to the market, which makes life easy. And then obviously if it's a company facilitated liquidity program, the company would offer a certain price, exactly.
Right.
Yeah.
And collectively, can you give us some sense of how up and to the right this business is growing? Is it growing 10% a year, 20%?
You mean the secondary trading
Yeah,
marketplace?
the secondary trading marketplace.
Well, I will say we've seen, over the last 4 years, we've had double-digit and triple-digit growth in the size of our business and in terms of the transaction volume we do. So, from our perspective, it's a fast-growing market. What other brokers in the space are seeing, I'm not necessarily clear on where their business is going.
No trade association?
There's no trade association for what we do, unfortunately. But we do collaborate with a lot of other broker dealers, and I get the sense that most of the other broker dealers that we regularly collaborate with are having healthy business conditions as well. So I think we're in a fast-growing marketplace. I couldn't put a growth number on it, but it's healthy.
Any storm clouds on the horizon that might put a damper on this growth?
Well, if the IPO market shuts down, I think you could see less interest in the names that we trade. So far, we haven't seen that. The aftermarket performance of certain post-IPO trades hasn't helped, but like I said earlier in this discussion, what we've seen is just supply and demand go into action, pricing is adjusting, and a lot of trades are still getting done, so.
Yeah, I think I think a lot of this volume growth in secondaries is being driven by non-traditional buyers entering into the market. I think that category of buyer would probably be the first to withdraw if there is a severely adverse market event that impacts tech companies. So we could see things normalize, but there's also a category of investor that is a new entrant to the market that's probably here to stay, and I think those are some of the more institutional, non-traditional secondary buyers who view this as kind of a part of their venture allocation.
Do you have a question? Yeah. Comment?
So not to be the skunk of the garden party here, but isn't this really a lot of the growth in the secondary market is two-factor deal? It's that companies are going IPO much later than they used to. You don't have a Microsoft going out at 50 million like you did 25 years ago, and that we're in the late stages of the bull market. So the simple question is, where do you see the market for secondaries happening, in 5 years? Is it going to keep going like this? And if companies, they probably won't start going IPOs earlier anymore. That's just the new norm. But if they did, a lot of this secondary market is going to go away, right? So I mean, there's a threat there, I think, and potential to that market, and if there's a cataclysm again, then even though that's the best time to buy these, nobody's going to be buying. That's just the reality, right?
Well, I think that the forces that are causing companies to stay private longer are not going away, basically. I like to quote it, when the Wilshire 5000 Index was founded, there were 5,000 public companies in the United States. Now there's 3,800 in the Wilshire 5000 Index. There's, companies are staying private longer, and and the reasons for that are mainly that there's plenty of capital, right? And there's companies like Industry Ventures that have, that weren't companies like Industry Ventures 20 years ago. So there's a lot more capital in the private marketplace that's going into these companies so they can stay private longer. And why would they want all the hassles of being a public company and scrutiny every quarter, having to meet numbers, and also employee retention? I mean, once your employees get liquidity, they can leave, and you lose the golden handcuffs. So all these trends that are keeping companies private longer are not going away.
Well, I mean, if Sarbanes-Ox went away, which it's not. I mean, we're presuming, back in 30 years ago, you never thought this kind of thing would happen. Like, things change. So, there's, things change, and we don't know what's going to happen in the future. I mean, I think this market's going to continue, but it's, it's not going to be all roses as far as I can see, right?
There's a ton of money, like Tomasic putting money into DoorDash and other deals where there's just SoftBank's Vision Fund, right? There's just a ton of money chasing deals. Supply and demand, as Glenn mentioned. I don't think it's going to end.
Yeah, when there's so much easy money out there, and rates are so low, and T-bills are getting 1.6%. You know that there's a huge amount of capital chasing a limited number of opportunities. So for now, all that capital is still out there, and it's going to chase deals like secondary trades.
I think the scenario that you describe is one where a lot of the capital that has piled into these deals starts to look for a release valve. And I think, to your point, that valve may end up being smaller than it is today because a lot of the buyer demand will go away. So what we would end up with is a significant supply and demand mismatch. And if anything, I think it would probably wreak havoc on pricing.
In the end, is this going to be more or less coincide with rise or fall of the IPO market? If the IPO market goes back to the way it was 4 years ago, when there were 3 IPOs, tech IPOs, I made that number that there was a valley, real quiet IPO market for tech companies in the past. Isn't that going to have some impact on the interest of buyers?
Sure.
Yeah, of course.
Exit timeline is an important factor in determining your investment decision. So, I mean, if the IPO market is perceived as closed, it's going to affect buyer interest in some of these names.
The M&A market didn't dry up at the same time.
Right.
Those will be trading.
It's
But
just
isn't there a
discount.
different factor now with the IPO with China and Hong Kong making its play, that it puts more pressure on us to continue to spur the innovation, the new upcomers, because they're moving very rapidly, we're playing catch up, we need it. I mean, if you look at the transactions going on in China now with the QR code and the velocity of cash and how it flows, it's just astronomical. We're in the late ages right now, still held in cash. We have to change in order to compete. So the new innovations and the IPOs that are coming up, the upcomers, they have to exist or we won't.
Oh, that's all macro stuff. Michael?
I think,
Thank everyone.
yeah, Cindy, did you have a quick question?
Oh, it's not a question, just like add, my thought as a family office, it's, yeah, so like actually we talk about like, we work, Uber and Lyft. Honestly, as a family office, we all think they are, yes. And, honestly, like the first thing out of the game will be WeWork, because we just don't see what's the core value here. Like basically it's office rental, that's it.
Right.
It's like whatever AI they are saying is like a garnish on the dish. It's like cilantro, it's like parsley, it's not even the main dish. So it's like, we don't see the core value of this, that's number one. And second, Uber and Lyft. So I would say that's almost like a Blu-ray DVD phase of self-driving car. So basically we have the traditional taxi, which I would say is the first generation of DVD. And then we got Blu-ray DVD, which is Uber and Lyft. Basically connect people together, but only in big cities. Because that business model only works for San Francisco, New York, Boston, and some major parts of like maybe China, like Shanghai, Beijing, but it won't work even in, let's say, Kansas. Like it just won't, like because like you need a big population to make that business viable. Like, and if Uber, let's say like Uber and Lyft, why they lose so much money? Because they expand crazy, but their business model only works in certain major cities. That's it. Like the business, the effort they are putting in, the money they are putting into expanding into those places won't work for them. So basically, like when we look at WeWork, Uber, and Lyft, and we don't see like those are the disruptors. We don't see them represent the next generation of real technology. Basically, I would say the disruptor of Uber and Lyft will be the giant of self-driving cars. Basically, we haven't seen that yet. I don't think it's gonna be Tesla either, because I don't think like they currently have the technology to do real self-driving cars. I foresee that's gonna be another 5 to 10 years or even more. And something like WeWork, I think it's basically a huge bubble. Like, so basically we've seen like the huge like bloom of like an incubator in China as well. But most of the huge incubators, they are like mostly government funded, and they have like a big amount of cash, and they are not about profit or loss. Like they are more about like, okay, we as a major city like Shanghai, like Beijing, we need to have a certain number of incubators, and it's like a goal we need to meet. It's not about how much money we make. But in the US, everything is about, can we make money? Can we make more money? Can we continue making money? And the answer is no for that business model. Thanks.
You guys, I just want to thank Richard Horning and the panel, and thanks very much for staying here to the